This is the PowerPoint for Chapter 1. First of all, I want to define accounting. Accounting is defined as an information system that provides reports to users about the economic activities and conditions of a business. So notice it's a system that provides information to users. The accounting principles that we follow are called generally accepted accounting principles. These are the rules that we follow in accounting. If you're going to be preparing reports for people outside the company to look at, they need to know that you followed a standardized set of rules, and that's what GAAP is. The organization in the United States that develops GAAP is called the Financial Accounting Standards Board, or the FASB. There are several concepts that we follow in accounting. One is called the business entity concept, and that says that the activities of the business are recorded separately from the activities of the owners, the creditors, or other businesses. So each business is treated as a separate entity. There are three basic types of businesses. A proprietorship is one that's owned by one individual. Most of the businesses in the United States are proprietorships, but they really make up a very small part of the overall activity in the United States. There are a lot of them because they're easy and they're cheap to organize. The primary disadvantage is that the resources available to the business are limited to those of the owner. Most small businesses organize as proprietorships. The second type of business is a partnership. It's similar to a proprietorship except that it's owned by two or more individuals. Only 10% of business organizations in the United States are partnerships. The advantage of a partnership is that it combines the skills and resources of more than one person. So there's more than one person putting resources into the business, and then each person gets to concentrate on what they do best. The third type of organization is a corporation. It's organized under state or federal statute, so it is a separate legal entity apart from the owners. Even though only about 20% of the businesses are corporations, they generate over 90% of business revenues. Ownership in corporations is divided into shares, and these are called shares of stock. And a corporation issues stock. And we'll talk about a corporation later in the semester. Early in the semester, we're going to be dealing with a proprietorship because that's the easiest type to understand. A second concept that we follow is the cost concept, and that says amounts are initially recorded in the accounting records at their cost or their purchase price. The third concept is the objectivity concept. Amounts are recorded in the accounting records based on objective evidence. In other words, you wouldn't record an amount based on your own judgment. You have to have some sort of documentation or evidence in order to be able to record a transaction. And finally, the unit of measure concept requires that economic data be recorded in dollars. In the United States, we use dollars as our unit of measure. One of the main things in Chapter 1 is to understand the accounting equation, and there are three elements that go into that. First of all, assets. Assets are the resources owned by the business. Secondly, the rights of creditors or the debts of the business are called liabilities. And then finally, the rights of the owners are called owner's equity. And we can put those three things together in the form of an equation, and it's called the accounting equation. And it looks like this: assets equals liabilities plus owner's equity. So again, the assets are the resources owned by the business. They're on the left-hand side of the equation. The liabilities are the rights of the creditors, and they represent the debt of the business. And then the rights of the owners is called owner's equity. Now we're going to start out in Chapter 1, Learning How to Record Business Transactions. These are economic events or conditions that directly change an entity's financial condition or its results of operations. And we're going to start out with a business called Chris Clark. He's the owner. The name of the business is Net Solutions. And he's going to open up the business by putting $25,000 in a bank account in the name of the business. And everything we're going to do in this chapter revolves around the accounting equation. So this transaction, every transaction has at least two parts to it. Notice on this one, the business, Net Solutions, now has an asset it didn't have before. And there are specific types of assets or things that the company owns. One of those is cash. This business now has $25,000 in cash that it didn't have before. So as a result of this transaction, cash increased $25,000. The other part of the transaction is where the owner is putting money in the business. So the owner now has a claim against the business, and that's called owner's equity. His specific claim is called Chris Clark, the name of the owner, Capital, and that increased by $25,000. The second transaction is on November 5th, 2011, Net Solutions paid $20,000 for the purchase of land as a future building site. So notice transaction B. Now we have another asset we didn't have before. We have some land. So land went up by $20,000. We paid for that with cash, so cash went down by $20,000. And notice they are recalculating the balance for each account. Cash now has a balance of $5,000, land has a balance of $20,000, and Chris Clark Capital still has a balance of $25,000. Notice that the equation still balances. The left-hand side, the cash plus the land totals $25,000, and then on the right-hand side, Chris Clark Capital is also $25,000. The third transaction, Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the near future. So now we've purchased another asset. It's called supplies, and that increased by $1,350. Agreeing to pay for something in the future is a debt or a liability. And specifically, when we owe suppliers, the particular account is called accounts payable. So a liability, accounts payable, increased by $1,350. Notice they recalculated the balances, and the left-hand side of the equation, which now is the cash plus supplies plus land, that totals $26,350. That balances with the right-hand side of the equation. Chris Clark Capital plus accounts payable is also $26,350. Next transaction on November the 18th, they collected some cash from providing services to customers. The money that the business earns by selling goods or services to its customers is called revenue. Since this is a service organization, the type of revenue we're going to earn is called fees earned. And notice we collected that in cash, so cash increased $7,500, and fees earned, which is revenue, and it's part of owner's equity, increased $7,500. And they recomputed the balances again just to make sure the left-hand side of the equation still equals the right-hand side. Revenue can go by different names depending on the type of revenue. If it's from providing a service, it might be called fees earned, as it was in this case. If it's from selling merchandise, it would probably be called sales or sales revenue. Other types of revenue include rent revenue, interest revenue, and so on. Okay, we're going to see in just a few minutes an account receivable. This is a claim against a customer. It is considered an asset. So if we provided a service for a customer and they didn't pay us immediately, we would receive an account receivable, but that's still considered an asset. We'll also be looking at expenses. During the month, Net Solutions spent cash or used up other assets in earning revenue. Assets used in this process of earning revenue are called expenses. So on November 30th, Net Solutions paid the following expenses: wages, rent, utilities, and miscellaneous. Notice they paid those, so cash went down by the total $36.50. Expenses are going to decrease owner's equity, so they're listed as negative numbers. Notice the revenue, fees earned, is a positive number, and the expenses are listed as negative numbers. Now, what we're developing here, this is not really how we're going to do it when we get to Chapter 2. This is a rather informal way of recording transactions, and it's a good way to start, but in Chapter 2, we're going to change this around and learn how to make journal entries, which is what you really do. Next, on November 30th, Net Solutions paid creditors on account $950. Notice we had owed $1,350 on accounts payable. Now we're going to pay $950 of that. So cash goes down $950 and accounts payable goes down $950, and you can see now that we still owe $400. On November 30th, Chris Clark determined that the cost of supplies on hand at the end of the period was $550. Notice we initially bought $1,350 worth of supplies. Now we've determined that we have $550 left, so the difference, $800 of supplies, must have been used. Any asset that's used up is called an expense, so notice here we're transferring $800 out of the supplies account into the supplies expense account. And again, the supplies expense is listed as a negative because it's reducing owner's equity. Finally, on November 30th, Chris Clark withdrew $2,000 from Net Solutions for personal use. So cash went down by $2,000. When the owner takes money out of the business for personal use, it's called drawing. And drawing is part of owner's equity, and it reduces owner's equity. So you see the new account, Chris Clark Drawing, and it's listed as a negative again because it's reducing owner's equity. We're going to look at, once we have recorded the transactions for a period, we're going to look at financial statements. These are the reports that are prepared for users. There are 4 types of financial statements. There's the income statement that summarizes the revenues and expenses for a period of time, such as a month or a year. There's the statement of owner's equity, which looks at how owner's equity changes during a specific period of time, such as from the beginning of the month to the end of the month, or from the beginning of the year to the end of the year. We'll look at a balance sheet, which is a list of the assets, liabilities, and owner's equity as of a specific date. So it only covers one day, and usually that's the last day of the month or the year. And then finally, a statement of cash flows. This summarizes the cash receipts and cash payments for a specific period of time, such as a month or a year. We're not going to do much with the statement of cash flows until much later in the semester, and then we'll have a whole chapter on that. You can read these notes on your own. Again, the income statement summarizes revenues and expenses. If revenues exceed expenses, that's called net income or net profit. If expenses exceed revenues, that's called a net loss. Statement of owner's equity, I've already talked about. Also, the balance sheet lists the assets, liabilities, and owner's equity as of a specific date. And that's the end of the PowerPoint for Chapter 1. If you'll look at the next YouTube video that I'll have up a little bit later, I'm going to work through some of the problems at the end of Chapter 1.